This is the pre-conference, so we'll actually have a welcome when we get started later this afternoon. But Kristen, you want to say hello and how long you've been with Evershed Sutherland?
Sure, I'm Kristen Burns, and I've been at the firm for just over 7 years now.
And Dwayne?
Hi, Dwayne Dupree. I've been with the firm for 13 years, if you can believe that, if you add it all together.
You add it all together? So, and if anybody wants to move forward, we've only got one person in that front row, so we can see you. The light's a little bit in our eyes. So what we're going to talk, thank you very much. What we're going to talk about today is just juxtaposing private versus non-traded BDCs. It's obviously one of the most popular things that's going today. Obviously, the multi-class relief being granted to BDCs is one of the reasons, and there's been a couple of really large offerings. One issuer obviously raised $15 billion. So seems like everybody wants to talk about this, so we added it to the program. So we're going to try and talk through some of the issues around it and walk through all of those things. So, and there's about 9 of the non-traded multi-class, but there's about 13 that are private. So, and prior to this year, the private were more popular. So why don't we just jump in and get started? And Kristen, maybe you can just talk through those different structures.
Sure. So we have the non-tradeds, which can either offer a single class of stock or multiple classes of stock. And then there's also the private BDCs. And the main difference, so all of the different types are subject to the 34 Act, the same reporting requirements, they have the same tax advantages, and they're subject to the same 1940 Act compliance requirements. The main differences relate to the manner in which they're offered and the liquidity that they afford shareholders. So on a very high level, traded BDCs are offered through a traditional registration statement and with an IPO process, and they're listed on a stock exchange. Private BDCs are offered in a private placement that's exempt from registration requirements, and they usually have a capital call or drawdown structure and then contemplate some sort of liquidity event or wind down within a defined period of time. And then non-traded BDCs, which I mentioned, if they have exemptive relief, can offer multiple classes of stock, are offered in a registered offering, but they are not listed on an exchange, which is why we refer to them as non-traded. And they usually undertake periodic repurchase offers through the tender offer process. And they can indicate that they'll list or have some sort of liquidity event within a set period of time, but more recently we've seen them be sort of this perpetually non-traded vehicle.
And why did this happen this year? Why did all of a sudden the non-traded start to become so popular?
That's a good question. I think partially because we finally got exemptive relief after, I think it was 7 to 10 years that it took to get that. So other folks are getting that, and beyond that, I'm not really sure.
No, I really do think the relief is what inspired it, because there was a number of non-tradeds about 8 years ago, whatever. There was, I think there was a large number of them, and they kind of waned a little bit. And there was no real reason, but the SEC had about 10 applications that they never really acted on. And I can't tell you that there was a reason why they actually decided that multi-class was okay, but now it is. And so people are lining up, and it's pretty perfunctory in the closed-end area to have multi-class relief. So it looks like it is moving along really well. So Dwayne, maybe you can just talk for a minute on the operational requirements, since the structures do get a little bit more complicated, and just what's the difference between the private and the non-traded?
Sure. For non-traded BDC, particularly when you get into multi-class space, the main difference for a non-traded BDC and a private BDC is that the non-traded BDCs have a state registration process. So as Kristen mentioned, the private BDCs are offered in a private offering, and the public BDCs are publicly traded, so they are covered securities under securities law. Non-traded BDCs, they offer securities that are not covered securities, which means that states have the right to regulate those securities, and they do. So each state, you have to register in each state that you want to offer securities generally when you have a non-traded BDC. And the state registration process is in addition to the SEC registration process. So there's really an extra layer of process there. And then another difference about a non-traded BDC is that it is in a continuous offering, meaning that there's no shelf takedown process. You have to file once you're effective in the states, and with the SEC, you file a prospectus, and then you're offering off of that prospectus continually. So you have to keep the prospectus up to date with periodic prospectus supplements to add the material information that you would need to offer in a prospectus. So those are two kind of large differences. There are some other differences, like non-traded BDCs are generally offered through a broker-dealer channel, and because of that, they're subject to FINRA Rule 2310. And FINRA Rule 2310 says that you can't have organizational and offering expenses in excess of 15% of gross offering proceeds. And then you can also not have pay underwriters or any of their affiliates or broker dealers more than 10% in compensation. So there's a bit more of a FINRA process with non-traded BDCs as compared to private BDCs. And then when you add the extra layer of getting a multi-class relief, multi-class BDCs have to have exemptive relief. And the exemptive relief has a bunch of conditions in them and a lot of rules. But the high level point is that a lot of the rules are rules that apply to open-end funds. So you're really in this position where you have a closed-end fund that is complying with open-end fund rules. And one of the open-end fund rules, which you may be familiar, is 12B1. The multi-class BDCs have to have a 12B1 plan to cover distribution and servicing fees that are paid out of the BDC's assets, which requires the board to go through a little bit of some additional steps that you wouldn't have to go through in other BDCs. Another thing that non-traded multi-class BDCs have to do is have a multi-class plan, which governs the structure of the specific classes of securities and provides that those securities, number one, the servicing and distribution related fees applicable to the specific class of securities. Number two, it generally specifies that the class can only vote on if there is a matter that affects a single class, only the members of that class can vote, but usually the classes are pretty similar after that. So really, there are a bunch of other fees, a bunch of other rules that apply to non-traded multi-class BDCs. You probably don't need to go through them all here, but there are probably 10 other rules that are very specific, and they usually apply to open-end funds, but that's a high-level difference.
Right, so you've got really a lot of additional regulation. I mean, once you get it up and running, maybe it operates more, very similar to everything else, but you've got state regulators, which you've got basically a comment review process as opposed to the notice process, and then you got FINRA, who is going to look very closely at this because they've got the caps, right? And then you've got these additional rules that apply that don't apply to other BDCs. So somebody jumping into this really needs to spend some time on building out some of these compliance requirements.
Yeah, that's right. And I think we'll talk about this a little bit later, but the ramp period for a non-traded BDC compared to a private BDC is going to be a lot different because of those considerations.
Yeah. And Kristen, in addition to what we were just describing, there's also some governance requirements. What are those that apply when you get the multi-class relief?
Yeah, so Rule 12B1 does, as you implied, impose specific obligations on the BDC's independent directors. Fortunately, a lot of them are things that a board would do regardless. For example, the independent directors have to nominate other independent directors. Any independent counsel needs to meet certain requirements under the 40 Act. You have to have periodic board self-evaluations and executive sessions. The biggest difference is the board is required to approve the 12B1 plan, and so if you are in a multi-class BDC, you don't have a 12B1 plan. And then in addition to that, there's all the normal obligations of a BDC board, such as approving the advisory agreement under the 15C process, the 38A1 compliance program, quarterly valuations, and having a chief compliance officer.
Right, yeah, I mean, all the same what we're talking about is what's almost in addition to what you have to
Right.
normally do for any kind of BDC structure. So, Dwayne, maybe we, instead of just bantering around about 12B1 plans, maybe we tell people what it is and what they have to do, because this is more of a mutual fund concept, right?
Yeah, it is. So a 12B1 plan covers distribution-related fees and servicing fees. So really what the plan does is it tells you what fees, it governs basically what fees the BDC can pay on behalf of shareholders for these sort of services. So that's what a 12B1 plan does. And in a multi-class BDC, there are generally two types of fees. There's an asset-related distribution fee, and then there's a servicing-related distribution fee. For the asset-based fee, it's generally an upfront sales load that is paid directly by shareholders based on the net asset value of the shares purchased in the share classes. So different share classes have different sales loads. And then this service-related fee is paid directly by the BDC to the dealer manager, who typically reallows it to a participating broker-dealer. And what those fees are intended to cover are the shareholder services that the shareholders receive from holding the shares. So those are account-related services, mailing, forwarding, sort of statements and things like that to the shareholders. So a lot of that is what those fees are intended to do. Now, if you compare that to what happens in a private BDC does sometimes have placement agent fees, but those placement agent fees are paid directly by the advisor to the placement agent. So they don't come out of the BDC's assets, and they also are not paid by shareholders. So really in a multi-class BDC, you have two different sort of payment mechanisms for getting through those distribution channels.
So and most of the BDCs today, the multi-class, have 3 classes, but you can't have more. Yes. It's not restricted. But you have to present the information about these various fees and the calculations to the board of directors on a quarterly basis. So there's reporting requirements. So the administration of some of this is fairly technical. Once you build it out, it's not a big problem, but you got to build it out and find a good vendor to help you take all that in and produce the information you need, right?
Right.
So, Kristen, we've been talking about distribution fees, but how about management fees, comparing those between the private and the non-traded?
So there aren't any structural or legal differences between the management fees and the private and the non-traded, but we have seen for a while now, private BDCs will charge initially a lower fee that will automatically increase when the BDC lists on an exchange. And this is basically because of the perception that a private BDC is less labor intensive than a traded BDC.
Well, it doesn't. The fee can, as long as you've told people about the fee, you can do it after a certain asset size, or there can be other cutoffs, and that's obviously very common in the the mutual fund world. So yeah. It's not. So it's in addition. I do think that the portfolio here is probably a little more liquid, especially in the permanently private. Because of the fact that you've got to have cash in order to pay dividends and that type of thing. So what about any other additional requirements for the multi-class if you were talking about a private as a non-registered?
Yeah. So we haven't seen any private BDCs that have multi-class relief. I don't see a reason why you couldn't have it, but we just haven't seen it yet. What we have seen is that there are a bunch of private BDCs that have requested multi-class exemptive relief, and the SEC has not granted it yet. So I'm not really sure why that would be the case, but I think that all of these, if you're going to apply open-end mutual fund rules to a closed-end fund, I don't see why you couldn't do it to a closed-end fund that wasn't publicly offered. I don't think that there's a big difference. I don't know if you've thought about that, Cynthia, but.
No, I mean, I don't see any reason why it couldn't be applied in both. So I think I think we'll see what the staff has to say about that in the near future, because I think there are people who are requesting it. What about the structure of the offering? You've got in a non-traded. Can you pair that with any other type of a private transaction, Reg S transaction?
Yeah, we've seen a couple of multi-class BDCs do simultaneous private placements pursuant to Reg S, and these are usually done through a feeder fund structure. So the feeder fund will solicit investors that are non-US, and then the feeder fund will invest in the BDC, but they'll receive unregistered shares under Reg S.
And that's just so you can offer to foreign jurisdictions, and that really hasn't created any real issues for the multi-class?
It hasn't, and it saves you shares on your registration statement.
And the private BDCs have always done offerings abroad, so this is just I guess a little bit of an add-on here, but it's consistent with what I think people have seen before. Just to go on to liquidity and permanently private, since that's now a coined term. Dwayne, can you explain what the liquidity events or how that works with a non-traded or a private?
Sure. I think the main way that you get liquidity in a private BDC or non-traded BDC is through a tender offer. For private BDCs, it's usually not periodic. It happens occasionally. But for non-traded BDCs, it's usually periodic, happens quarterly. And what they do, is particularly in the non-traded space, is they offer a certain percentage or certain dollar amount of the outstanding shares and then offer to repurchase those shares. So that gives shareholders some liquidity for these structures. And as Kristen mentioned, there is usually in a non-traded or private BDC space, I'll say historically there has been in the non-traded and private BDC space, there's been a time frame, offering period, and after that offering period, there'll be a liquidity event. Some new structures are now permanently private, so a lot of the multi-class BDCs, I believe all the current multi-class BDCs are intended to be perpetual. So what those BDCs do is they offer typically 5% to purchase 5% of their shares back every quarter, and they just will continue to do that, and there's no set liquidity event in sight. Whereas before, we were previously seeing 5 to 7 years where people would want to have a liquidity event and either go public or do something else so that shareholders could get their capital back.
And that was patterned after the non-traded REITs, right? That's where that came from. There's no statutory requirement for that 5 to 7 years, and people follow these pretty much once you start having a particular structure, it gets followed. But one of the on the repurchases or the tender offers, because of the way the BDCs are structured, you have to actually put together all the paperwork, and the timing on those are very are a little bit difficult to manage. Is that?
Yeah, that's right. It's unlike a interval fund. It's not who has a fundamental policy to purchase a certain amount per quarter or per year of shares. These are all discretionary tender offers. So when you have a discretionary tender offer, you have to actually send all the paper out to shareholders. You have to count the days. It has to be open for 20 business days, and there are these very technical rules that you have to follow. And most of the time, I'm sitting there counting the calendar to see if I get up to 20 business days. So it's really a process when you do it. But once you do it, once you get into the habit of doing it, it becomes easier over time.
Right. And then what are some of the examples, if you are one of the non-tradeds that had that 5 to 7 year language in it, what are some of the liquidity events you might enter into?
Most commonly, it would either be listing on an exchange or a merger into a listed company, which would afford the private shares listing. We have seen some spin-offs, but they do require exemptive relief, but that would be where the private BDC spun off and the private BDC shareholders would have the choice to either stay in the private vehicle or go into the spun-off listed vehicle. Usually the documents will not specify the specific liquidity event, which does give management and the board the ability to choose the best option based on what the shareholders want and what the market is at the time.
And there's usually a fair bit of discretion built into that liquidity event. Even if you get to the 5 or 7 years and the market's not ready, the board has the ability to extend that if need be, right?
Yeah, most commonly we see like 2 1-year extensions.
So, and just to talk about ramp time, and you already alluded to this, Dwayne, and maybe just before you talk about that, talk about the pricing that goes into the private and non-traded.
You mean like the?
How do you price these deals? What are people, is it NAV, is it monthly, is it
Yeah,
quarterly?
it's usually for multi-class BDCs and non-traded BDCs, they usually offer at NAV or something that approximates NAV. So previously it was that we used to see commonly that private BDC would say it was in 2.5% of NAV. If it changed, they would have an offering price, and if that changed up or down 2.5%, they would move the offering price up to that current, what they thought was NAV at the time. Now we're seeing with multi-class BDCs, they want to say that they're offering at NAV. So there is a process that BDCs have to go through, as everyone's familiar with the quarterly NAV process. But really, if you have a multi-class BDC, you're doing that typically on a monthly basis. You're doing something that approximates really what you think NAV is. So that's one of the major differences. For a private BDC, you can't sell shares below NAV, but really other than that, you kind of have more flexibility in terms of how you want to price those shares.
Right, but and there are some people who've done some daily or weekly, but that is not because of the nature of the portfolios. It's a little bit difficult to do those, although some folks have tried it.
Yeah.
So maybe talk about the ramp, which I think is one of the biggest issues or biggest differences between the two structures.
Yeah, I think so. So for a private BDC, the ramp period is actually perceived to be a little bit easier because you have, as Kristen mentioned, the capital call structure and the capital drawdown structure. So the BDC can take all these capital commitments, they can go out and seek the best investment, and then when they find an investment that they want to make, they can draw down the capital to make the investment. So there, immediately you're putting the money to work when you get it from shareholders, and also the management fee. It's typically like on a drawn and undrawn basis. So that is good for both the managers and the shareholders. In a non-traded BDC, as we mentioned earlier, there's this state process that you have to go through even after you're effective from the SEC. So you have a longer process in general. You have a state process. Then you have to have the exemptive relief as well. So there are two additional things that you have to have. And then on top of that, as I mentioned, it's a continuous offering for multi-class BDC and non-traded BDC. So once they usually have closings every month, some of them had weekly closings in the past. I think it's kind of migrated toward monthly. But at the end of the month, you're getting X dollars, and the advisor wants to put that money to work immediately. So we've seen people manage this in different kind of ways. The exemptive relief can be managed by getting effective with the SEC and getting effective with the states, and then only offering one class of securities until your exemptive relief is granted. That's one way to kind of manage the ramp-up period there. And then another way to manage it is through warehousing transactions or formation transactions that BDCs have been getting into. And that's to manage the ability to have a portfolio basically when you receive cash.
Well, and maybe we can just talk for a second on, Kristen, one of the things that is the non-traded and the private, there is a subscription process, right? And the folks who are investing in these, they're looking for the same type of things that they would normally get in a transaction that was fully private, right? Not in a BDC structure. And is that something that we have to negotiate, because you got to have the common stock's got to be the same for everybody, right?
Right. So we do often, especially in the private structure, receive very long and detailed side letter requests, and we say no to most of them. But yeah, people are in the private space expecting bespoke accommodations. The private BDCs can't offer multiple share classes, so they do have to treat all the shareholders the same.
So it is a little bit of a hybrid. So it's a little bit. There's a fair bit of education that goes on in this. And what is the leverage requirements in these? Can they take advantage of the 150, or where are we on that?
Yeah, I think there was some, when the legislation came out, there was some hesitation among non-traded BDCs because in private BDCs because you had to offer to repurchase basically all of your shares, and if you have a liquid portfolio, it's very hard to do that. So what people have done, particularly in the non-traded private BDC space, is that the initial shareholder will approve moving to 150%. So that hasn't been an issue for new private BDCs and non-traded BDCs. For the older ones, you see a lot more variation there.
And that might have been one of the reasons that the non-tradeds kind of waned as far as being popular, not only with the multi-class, but also the leverage was pretty difficult. And I think there might have been a few people who actually tried to get the benefit of the change, but it's very few. Kristen, maybe we talked a little bit, or Dwayne talked a little bit about warehousing. Can you just talk about that for a second on what that is or why that might help a ramp, or you or Dwayne?
Sure. So the warehouse transaction is basically, these transactions are basically to get capital into the BDC, so it doesn't start with, as a blind pool. So in a formation transaction, generally the BDC purchases a portfolio of assets from usually a related fund, and then it starts with those assets. In a warehousing transaction, it's a little bit different. The BDC enters into a forward purchase agreement with a warehousing provider, and what the forward purchase agreement says is that the BDC will be conditionally obligated to purchase assets from the warehouse provider if the BDC meets these conditions. And one of the conditions is usually that the BDC raises a specific amount of money in subscriptions. So once the BDC raises that amount, then it becomes obligated to purchase these assets, and then it purchases the assets into the BDC. These forward purchase agreements came up really as a way to kind of get around leverage, because the leverage under the current rules, and we'll talk about this later on in the BDC Roundtable, the current rules, the leverage requirement, when you have a conditional forward purchase agreement, it doesn't count as leverage until the condition is actually met. So that allows the BDC to not take these assets, which it is obligated to purchase conditionally, onto account for leverage until it actually has the subscriptions and the amount of money to back it up.
It really comes down to a timing issue, right?
It is timing.
And how fast you can get, Kristen, maybe you can talk about the timing, because that is one of the biggest distinctions between the private and the non-traded.
Yeah, so in the non-traded, the timing, as Dwayne mentioned, is a lot longer. And it's mostly just because of the structural differences. In the non-traded structure, the main offering document is a Form N-2, which we're all familiar with, and that's subject to SEC review, and it can usually take 2 to 3 months from initial filing to effectiveness. And then you also have the state blue sky process, which can take up to 6 months. You have to register the shares in each state because they're not covered securities. And then you layer on top of that the exemptive relief process if you want to offer multiple share classes. So you're talking about generally at least 6 months from when you first file your registration statement until you can begin offering. The one thing to note there is that you can make your initial filing confidentially, whereas in a private BDC, it is a shorter process, but you have to make your first filing, which is a Form 10, public. There's no ability to privately file a Form 10. The advantages, though, are that the Form 10 becomes automatically effective in 60 days, so that's sort of your time frame there. The Form 10 is not an offering document, so you have to layer on top of that a PPM and a subscription agreement, but those are not subject to SEC review, so the timing there is, whatever your drafting process is. So in theory, when you add this all together, you could be done in 2 to 3 months. Obviously, it takes a little bit longer to sort of find your investors and ramp up your compliance program, but it's significantly shorter than with the non-tradeds.
And it's really around some of the uncertainty on the states, right? Because they're in addition to everything else, they can add quite a bit of time.
Yeah, you're essentially negotiating with, not all 50 states, some are easier than others, but some of them can have a lot of comments, and I think partially because of COVID, but even before COVID, it was just a slow process. I think they're understaffed and backlogged.
right? And if you're trying to do an offering across all 50 states, you need all the states, not just some of them, and some of them actually give fairly substantive requirements or comments, and might even require some changes in documents, right? They've looked, and whether you're a corporation or a trust, they want to make sure that their shareholders in their states are taken care of, and they could try and require you to have annual meetings if you don't have that in your documents, and there's a lot of different things that they can really point to. I mean, you can get, how many, we've seen comment letters that go into the 20s, and particularly Washington State is particularly difficult, right, Dwayne?
Yeah, oh yeah, don't get me started. But the interesting part I found about the states is some states don't actually do a substantive review. They just rely on Washington and other states that do a substantive review to say, we'll clear you when that guy clears you. And so then it makes the state process a lot more difficult if you want to roll it out incrementally, because really a lot of the states are waiting on other states to clear, and then they sort of all clear. There are a couple that clear very early, but the bulk of them sort of clear very late in the process, is what our experience has been.
But and aren't there some requirements at the state level that are requiring that their investors can only participate in so many of these type of non-traded products, and you have to aggregate them? Isn't that like a 10% limit? You get some benefit on the suitability, right? So you don't have to meet the accredited investor standard, but what is that all about?
So basically, some states have a requirement that across all of these sort of non-traded products that you can only have an aggregate amount of 10%, I believe, of their net worth in these products. So it really has like a first mover advantage in those states if you get out earlier, because if you invest in some of those, there's really a limit, and that has to do with checking for the advisors and broker dealers, checking to make sure that you actually meet those suitability standards when the offering is going forward. And technically, I think you're supposed to like get out of it if your net worth goes down, and then you face some weird questions there, which luckily we haven't had to do yet. But that's what the states say you have to do in that case.
But the 10% aggregation would be your product and others' products.
Other people's products, yeah.
So it can be a little bit of a nightmare from a documentation standpoint, can it be?
Right. Right. I mean, it's an odd, if you think about it, it's an odd rule, because I don't know how much this particular person owns, and they have an independent broker-dealer or financial advisor or something that presumably is keeping up with that, but I don't think there's any way for the BDC itself to know whether that 10% is exceeded.
So, and Kristen, maybe you can talk a little bit about, in the private, you're required to be accredited, right?
Yeah, because the privates are offered under Reg D, you're required to be an accredited investor, whereas, as Dwayne mentioned, the various states, and it's also the North American Securities Administration Association, which I call NASA, but it's not, imposes various additional suitability requirements. And these are generally less onerous than the accredited investor status. So when you're offering a non-traded, even though you do have to satisfy these additional requirements, it opens you up to a broader range of investors.
Right. Everybody's trying to get to the mass affluent, I think is the terminology, right? And there's a lot of these. So what else is what are the non-tradeds? Anything else that you want to add to the suitability requirements that we were talking about in the legends?
The only thing I would add is that the suitability requirements are they are in the prospectus, and they're in the legends, and they have to be in the subdocs. So you actually have to have a process for making sure that those are met, and the states really check to do that. So that is, and also you can't rely on the suitability standards from one program to the other. So some states will impose stronger suitability requirements on different issuers for some reason, so that they're not entirely consistent across the states on what their suitability standards actually are for individuals. So when you're offering a multi-class, you have to be very cognizant of like what your distribution channel is, how you're going to meet these suitability standards, and who exactly you're targeting when you do that.
Well, and these can be done electronically now, right?
Yes.
That's actually one of the other features of why non-tradeds have become more popular is the point and click ability, right?
Right, yeah.
So it's a lot easier to follow that or whatever, or keep the records when you're talking about that. So, and really what we're talking about here is different channels, right, or different pockets that you can go to. So, Kristen, maybe you can talk about some of the different folks who are helping to offer these products, like the participating broker-dealers and that type of thing.
Yeah, so I think recently, and I think this has contributed to the success of some of the multi-class non-tradeds, we've seen them offered through existing wealth management platforms such as UBS or Ameriprise, Merrill Lynch, and that has been very successful. But the different distribution channels cover all sorts of brokerage and transactional-based accounts, wrap accounts, registered investment advisors, and then we also see private individuals, endowments, foundations, pension funds investing, and they invest in the different share class based on the fees that the broker is accustomed to receiving. And then the private BDCs can also offer through these channels, but the fees are a little bit different because, as Dwayne mentioned earlier, they're usually paid by the advisor, and you can't have, or we haven't seen multiple share classes in the private space so far.
Well, and the privates are, I think people believe that those are going more to institutions. Is that more of an institutional product?
It goes to, more to institutions and to higher net worth. The minimum investment in a private BDC is usually significantly higher than the minimum investment in a non-traded.
And then just once you get this up and running, is there, how do you deal with updating the information, making sure people have the right, they can make the decision to invest in the securities? Is there a process once you get up and running? I mean, you got to update your registration statements, do pro-sups.
Yeah, that's right. For a private BDC, you have Form 10, which is a registration statement. There's really no amendment or anything to that. So really it's a matter of updating the PPM periodically with material information that you want to include there. For a non-traded BDC or multi-class BDC, we really have to keep the N2 updated. And unfortunately, for non-traded BDCs, you cannot incorporate by reference. So when the BDC offering reform came, they said that if you were a BDC, a traded BDC that files on N2, you can incorporate by reference if you have a public float. Well, non-traded BDCs don't have a public float because they're not traded, and the definition of public float requires you to be traded on a national securities exchange. So what private BDCs have to do is they are stuck on the old process. Every year you have to you file your N2, and then you file the post-effective amendment, and then when 3 years come out, you have to file another N2. And as I mentioned earlier, the non-traded BDCs are also in a continuous public offering. So again, you have to update your prospectus supplement with material information. Most people file their prospectus supplement that just attaches the entire 10Q and the 10K. Some people include 8Ks in that, and when other material things happen. So it's a more sort of a laborious process, I guess, with a non-traded BDC, keeping up with the prospectus requirement than it would be with a private BDC.
But otherwise, once it gets up and running, really we're talking about the capital raises, right?
Right.
Otherwise, the compliance, the reporting, any kind of governance, that's really pretty much consistent, right? There's not many issues there. So.
Not really. One thing I forgot to mention was that so for private BDCs with this institutional investor base, you have to actually pay attention to how many investors that you have that are ERISA investors, because if you have more than, I believe it's 25%, then your assets of the BDC become like plan assets, which would subject you to a number of restrictions. So that is one of the areas where you have to pay attention. Also, another area is like the fund of funds compliance when you're letting investors into a private BDC.
There's also some issues around how many shareholders you have and whether you can be a RIC, right, that is from a tax standpoint.
Right, like you have to have a number. You have to be a publicly offered RIC, which if before you have the certain number, I was a tax lawyer, but I don't want to guess here. I'm not anymore, I'm retired. But you have to have a certain number, and if you have under that number, you have to basically pass the expenses of the BDC through to the shareholders. The unfortunate part is the shareholders can't take those expenses as deductions. So really, you want to be a publicly offered RIC. I want to say it's 500, but
it's 500, and I wasn't a tax attorney.
It was. Well, I didn't want to. I knew what it was, but you know. But you have to have 500 investors, so that you can qualify for that, and then get the preferential treatment for the shareholders.
Well, and there's a number of platforms out there that have private and non-traded.
Right.
Any reason not to have that?
Any reason not to? Drive your attorneys crazy. Yeah. But other than that, no. It's. I think it depends on what your what investors you want to target. So if you want to get into the non-traded, so mostly targeted toward retail investors. If you want to target retail investors and have those lower standards. But I also should mention that most multi-class BDCs have like an investor, a class I share, and so the minimum investment is anywhere from $10,000 to $25,000. For the usually Class S and Class D. For the iShares, it's $1 million, and it doesn't have any fees on it, and then also it doesn't have any distribution fees, it doesn't have any servicing fees. So just because you offer a primarily retail product doesn't mean that you can't get into the investor class with those, and I think that's the attractive things about these non-traded. You can be in multiple distribution channels with the same product, and you don't have to have these like sort of mirror funds that do that. And I think that's very attractive to people.
The key at the end of the day, I think, is really what distribution channel do you want to use? And if you are going to use a non-traded, there's a very specific way that they're structured, certain things you have to do. In a private, I think there's a little more flexibility, although you need to be able to go to some more the institutional base to make the product viable. So it's there's a lot of questions to go around. I don't think there's an ultimate answer to which one you should be doing. But I do think that these are going to continue to be popular just because people are having success with them, and the products or the requirements are becoming more clear. So I don't know if there's any questions. Hopefully that was helpful and informative. No questions? We answered all the questions? Fantastic. Well, that's what we wanted.
There was one.
Oh, sorry.
Dwayne, thank you. And guys, wonderful. So one question got to the 2310, right? FINRA rule. And so that's a maximum cap on fees of what? Just to familiarize us with the rules, like 10%, something.
It was 15% on organizational and offering expenses of gross proceeds, and then also 10% of any compensation paid to underwriters, broker-dealers, or their affiliates of 10%. Yeah.
So the question is, effectively capital gets raised, and then at some point the fees shut off, right? Because you hit that cap. And so my question to you is, how aware is the broker-dealer community, right? Because lots of folks, when they structure these arrangements, whether it's the upfront fees and the trails, et cetera, oftentimes there's a view, unless there's a listing event, to your point on private structures, that those fees operate with a higher degree of long-standing, right, or outstanding, right, compared to something that can disappear after year 5. Do you ever foresee a situation where the amount of capital being raised and fees paid effectively forces the fees to shut off, but the broker-dealer didn't really know that was going to happen?
So I think the products are they're so new. I don't think there's been this, what you're describing. I think in the REIT world, I have seen it has happened in the REIT world. And I can tell you that FINRA actually, if you're not monitoring this, they will just come and check you, and you may very well have to go back and redo some of this as a result. So it's so I think in the broker-dealer community, at least in the REIT space, they're very cognizant of this. Are they as cognizant in the BDC space? It's just such a new product right now that I don't think that all those kinks have been worked out and that everybody understands it. So I do think that focusing people on it is very important, especially as you're going through and you're negotiating those distribution, and you're talking about the wirehouses getting in on this, that they understand how that operates.
And also, to add on what Cynthia said, the fees right now have been very low. So you got this 10% cap, but usually the maximum upfront sales load for S share is like 3.5%. That maximum upfront sales load for a D share is 1.5%, and then the trail fees are 85 basis points and 25 basis points. So really, on a D share, you're looking at in excess of 10 years, and on a S share, you're looking at about 10 years. So I don't think people have actually had to budge up about that. And also, one thing I'll mention too is those are the maximum shares. I don't think that most broker-dealers are charging the maximum amount of upfront sales. So it's kind of hard to tell right now. I think the first multi-class that was up and running was like 2 years ago.
It was actually less than that.
It's
almost like I think it's less than a year. So
yeah.
But record keeping in this area, you couldn't have anything more important, and choosing a vendor that can do all of that for you is critical. Because most BDC folks or management teams aren't necessarily in this space unless you've been in the REIT space. So it's something you got to learn.
In that same line, you mentioned suitability from the states. How do the state? I mean, how are the states holding responsible the broker dealer who has the information that can more so do that calculation than the fund itself, or are the states coming to the fund and saying, how would you know if you hit a 10% limit in a state for those types of products? If you're putting that in your offering document, how would you monitor for that?
You have to code it. You have to monitor it by state and how many sales you're making in that state, and so that you'll be able to, that you'll.
Did I hear you say that it's across products, so it's not just your product, but other products, or it's just your BDC that you're looking at 10%?
You're looking across, and so in that context, you're probably looking more at the broker-dealer and to monitor that. And as far as so FINRA and the states have always had, on these non-traded products throughout their entire lives, have had some issues around them for a lot of the reasons we're talking about. I would tell you that the most part that the issuers are not getting the requests. It's usually the broker-dealers that the FINRA comes against, and they think if something's been wrong or they've been promising something that doesn't exist. But this 10%, we think the 10%'s very. It started in 1 or 2 states, and now it's kind of going across the country. We hope it doesn't continue. It doesn't, and we're still fighting it. So it's a process. And one of the things I say is that the state process is really difficult because they never wrote any guidelines for the BDCs, so that you default to the NASA guidelines for LPs. So a lot of the requirements that you may see in some of the charter documents, that type of thing, like rollovers and that type of thing, don't make any sense. And when non-tradeds were popular several years ago, we tried to get them to write a guideline, and there's some effort now to get new guidelines that'll go more directly to the BDCs. So, but it's the state process is really, there was a lot of pressure before. Now there's all of a sudden pressure again for them to do something better. So.
Can I add one thing, Cynthia? I think also to go to your answer, a lot of the ways that BDCs have been getting comfortable that they can meet this 10% is sort of, and other suitability requirements, is they push it off on the broker dealers. So usually the dealer manager enters into an agreement with the BDC, and then the dealer manager enters into participating broker dealer agreements with each broker dealer. And in those participating broker dealer agreements, it says you're responsible for suitability and you need to do everything that needs to be done there. And that's sort of your problem. I don't know if that works from a state standpoint, but that's what BDCs have been tended to do, is to push it down to the individual broker dealers. Because at the end of the day, if you're advising someone, you should know what they're investing in, especially because in the suitability standards are also Reg BI, best interests. So you're supposed to be actually making individual tailored recommendations to the particular people. So I think that they've been pushing it out.
And this 10% issue is very well, there may be people pushing back and saying there's not enough more shelf space to do a bunch more of these because of some of these issues. And that's what's kind of driving some of that. Okay, great. All right, well, hopefully this was helpful, and you'll get back for the next sessions and are welcome. So thank you.